The software exposure in private credit has been all over the press, so let's address it head on. What is the exposure? What does it actually mean? And what happens in the worst case scenario? We have to walk through the math and think about the rationale. The strategy itself has approximately 19% look-through exposure to software companies, underweight compared to broadly private credit exposure of around 25%. The first point is, the concern you're reading about in the press is a sector-wide conversation, and BDCI is not more exposed than the market. In fact, active management means the portfolio can and does rotate away from weaker software credits as conditions evolves. The reason BDCs learn to software companies in the first place and why it's a larger sector exposure is because software businesses are traditionally very attractive borrowers for private credit managers. They typically have recurring subscription revenue. That is the boring, predictable, contracted, sticky revenue lenders were looking for. They have high gross margins, meaning even in downturn, there is cash available to service debt. They sometimes have enterprise customer bases that are deeply embedded in their client operations. These are not speculative technology bets in venture lending. They are established cash flow positive software business with long operating histories. And the market currently is worrying or concerned about the future, even though we are not seeing widespread revenue declines of the overall private credit software companies. The AI disruption could erode the competitive modes of certain commodity software businesses and those setting broadly available, easily replicated functionalities. That could create refinancing risk when loans mature, maybe not immediate defaults, but potentially stress at the point of refinancing. And we think it's a legitimate concern and one that active managers are already positioning and shifting positions around. The distinction matters though. Infrastructure software with deep moats, think about cybersecurity, mission-critical enterprise platforms, is very different from commodity point, consumer-based solutions. Let's think about the stress test and how do we work through the math.
For this example, let's assume a scenario where market conditions are worse than they were during the global financial crisis in 2008, where 20% of software loans theoretically default. That 20% number is dramatically higher than even the worst GFC loan default rates, which reached approximately 10% at peak. Now, we'll assume for our scenario that there is 0% recovery on those defaults. Again, this is far worse than the GFC. In reality, these are senior secured loans with first claim on assets, so zero recovery is effectively impossible. In fact, during the GFC, recovery rates on senior secured loans were 60 to 70 cents in the dollar. So with those assumptions, let's do the maths. At the time of recording, we have 19% software exposure in our portfolio, which is still underweight to the index, which holds 25% software exposure. Multiply that by a very high 20% default rate and factor the 0% recovery scenario we outlined. Together, that equals approximately a 4% portfolio loss.
And this is precisely where active management earns its keep. The portfolio can be rotated, reducing exposure to software companies that we think are more susceptible to AI disruption and higher refinancing risk, and increasing allocation to infrastructure software business with stronger competitive moats and more durable cash flow. And passive BDC strategy doesn't have enough flexibility to change their holdings.
To learn more about BDCI, get in touch with our team.